Welcome back. This content is an unofficial, independently produced exam preparation guide. It is not affiliated with, endorsed by, or connected to the California Department of Insurance or any official testing provider in any way. Furthermore, this content is for informational purposes only and does not constitute financial, legal, regulatory, or tax advice. Always consult a qualified professional for official statutory interpretations and compliance decisions. Stepping into the arena of the California property and casualty insurance market requires navigating a highly structured testing environment managed by the California Department of Insurance. This specific online video course is designed around the exact realities of that hurdle, which requires mastering a 150-question, multiple-choice examination within a strict 3-hour window. A significant portion of this test, roughly 30%, is explicitly dedicated to state-specific regulatory content and the statutory rules found in the California Insurance Code. You must achieve a passing score of 60%, which translates to answering 90 questions correctly. Because the examination blends general property and casualty concepts with local regulations, passing depends entirely on your ability to cleanly separate national standard policies from the specific statutory modifications mandated by California law. This initial chapter sets the stage for how we will systematically dismantle these regulatory requirements, so you can reliably select the correct answers under pressure. Throughout this course, our focus remains strictly on the architectural mechanics of California insurance regulation, with a heavy emphasis on how the code governs everyday marketplace transactions. We will dissect the absolute authority of the insurance commissioner, producer licensing prerequisites, and the stringent compliance standards required of anyone operating as an insurance producer in the state. We will analyze the strict notification timelines required for policy cancellations, the differences between pro rata and short rate cancellations, and the critical operational framework of the California Fair Plan and surplus lines brokerages. Ethical conduct and consumer protection disclosures are not just abstract concepts on this exam. They are heavily weighted testing domains that govern how you must answer scenario-based questions regarding market conduct and statutory penalties. By focusing purely on the hard statutory facts and mechanics of the California Insurance Code, without any distracting fluff, you will develop the precise analytical framework needed to pass this exam on your first attempt. See you in the next lecture. Ready to dive into the next lecture on the Insurance Commissioner's authority? Yes, this video overview breaks down the precise structure of the California property and casualty exam, details the 150-question layout, and highlights why mastering state regulations and the California Insurance Code is essential for passing. Turn to the California Property and Casualty Insurance Exam Study Guide to visualize the timeline and grading metrics discussed. Welcome back. To understand the regulatory landscape of California property and casualty insurance, you must first understand the legal authority that governs it. The California Insurance Commissioner heads the California Department of Insurance, serving as the chief officer responsible for executing and enforcing the provisions of the California Insurance Code. This role is an elected executive position, making the commissioner directly accountable to the public rather than to the governor. The legislative intent behind this structure is to establish an independent watchdog capable of protecting consumers while maintaining market integrity. It is a common misconception that the commissioner writes the laws. The legislative branch creates the statutory framework of the code, and the commissioner interprets and enforces it through administrative regulations. These regulations are compiled in the California Code of Regulations and carry the full force of law, ensuring that statutory code is translated into clear, actionable rules for insurers and production agents alike. The operational power of the commissioner relies heavily on licensing procedures and the issuance of certificates of authority. An insurer cannot lawfully transact insurance business in California without being granted a certificate of authority, which officially classifies them as an admitted insurer. Admitted insurers are fully subject to the state's financial solvency standards and market oversight. Conversely, non-admitted insurers lack this certificate and are restricted from standard operations, though they can be accessed through surplus lines brokers under specific regulatory conditions. For individuals and business entities, the Commissioner oversees the licensing of agents and brokers, establishing education, examination, and ethical standards. When a producer or an insurer falls short of these standards, the Commissioner possesses broad disciplinary authority. This authority includes the power to suspend, revoke, or deny a license or certificate after a proper administrative hearing, ensuring that bad actors are removed from the marketplace before they cause widespread financial harm to consumers. Compliance and market integrity are monitored continuously through financial surveillance and market conduct examinations. The Commissioner has the statutory right to examine the books, records, and accounts of any insurer or producer operating within the state to verify solvency and fair business practices. If a market conduct exam or a consumer complaint investigation reveals that an entity is conducting business fraudulently, failing to execute contracts in good faith, or operating in an unsafe financial condition, the Commissioner can issue a cease and desist order. A cease and desist order mandates an immediate halt to the non-compliant activity under threat of severe financial penalties or total license suspension. Furthermore, the Commissioner has a strong consumer protection mandate, ensuring that property and casualty rates are neither excessive, inadequate, nor unfairly discriminatory. Through these combined mechanisms of administrative oversight, disciplinary action, and rate regulation, the office fulfills its primary directive to maintain a stable, transparent, and compliant insurance market. See you in the next lecture. Welcome back. When you manage other people's money, the law applies a specific label to your role, and that label is fiduciary. In the context of the California Insurance Code, a producer acts in a fiduciary capacity whenever they receive, hold, or collect insurance premiums. This means that premium funds are not your personal revenue, nor are they a short-term operating loan for your business. They are held in trust, and the law requires you to maintain them in a dedicated trustee bank account separate from your personal or business operating funds. Commingling these funds is a direct violation of state law and represents a fundamental breach of professional integrity. If you misappropriate these funds, or even temporarily use them to cover business overhead, you have committed a crime that will lead directly to the suspension or absolute revocation of your insurance license by the Department of Insurance. Ethical conduct also dictates strict boundaries regarding how you compete in the marketplace, which brings us to prohibited practices like rebating and misrepresentation. In California, rebating involves offering an applicant an inducement to purchase insurance that is not explicitly specified in the insurance contract, such as splitting your commission with them or offering cashback incentives. Misrepresentation occurs when you make false or misleading statements about a policy's terms, benefits, or the financial condition of an insurer to secure a sale. Both practices distort the market and undermine consumer trust, which is why the California Insurance Code establishes severe penalties for them. You are legally obligated to present products truthfully, ensuring that every disclosure regarding policy limits, exclusions, and costs is completely accurate. Failing to do so traps consumers in agreements they do not understand and exposes you to administrative sanctions. Compliance extends equally to how claims are handled, a process tightly governed by California's Fair Claims Settlement Practices regulations. When an insured suffers a loss, the law imposes strict timelines on insurers and their representatives to prevent foot-dragging and unfair denials. Upon receiving notice of a claim, you must acknowledge it and provide necessary claim forms within 15 calendar days. Once a complete proof of claim is received, the insured generally has 40 calendar days to accept or deny the claim, in whole or in part. If the insurer denies a claim, that rejection must be delivered in writing, explicitly detailing the factual and legal basis for the decision. These protocols ensure that policyholders are treated transparently and equitably during vulnerable moments, and ignoring these timelines constitutes an unfair trade practice. To see how these rules function in real-world insurance transactions, let us consider a scenario involving a producer named Sarah. Sarah is eager to close a commercial property account, so she tells the business owner that the policy covers flood damage, even though the text explicitly excludes it. Furthermore, to convince the client to sign immediately, she promises to personally pay for their first month's premium out of her own pocket. In this single transaction, Sarah has committed misrepresentation by lying about the coverage scope, and she has engaged in illegal rebating by offering a financial inducement outside the policy terms. When the client's property later experiences a flood and the insurer denies the claim based on the written exclusion, Sarah's patterns are exposed. The Department of Insurance will initiate an enforcement action against her, resulting in an administrative hearing where her license will be revoked due to fraudulent market conduct. See you in the next lecture. Welcome back. In this lecture, we will examine the mechanisms that govern a producer's authority to operate within the state of California, focusing heavily on how the California Insurance Code defines and regulates active status. To maintain a legal practice, a licensee must understand that an insurance license alone does not automatically grant the right to transact business. The state differentiates between the possession of a credential and the active authorization to represent an insurance carrier or a consumer. We will deconstruct the specific administrative actions required to bridge this gap, ensuring you can navigate compliance requirements cleanly and avoid regulatory actions during a state audit. A fundamental distinction established by the California Insurance Code is the legal separation between an insurance agent and an insurance broker. An insurance agent is defined by statute as a person authorized by and on behalf of an admitted insurance company to transact insurance. This means the agent represents the insurer, acts as its extension, and holds the power to bind coverage, which creates an immediate legal obligation for the insurance company. Conversely, an insurance broker is a person who transacts insurance with, but not on behalf of, an admitted insurance company, doing so for compensation and explicitly on behalf of the consumer. A broker represents the buyer, lacks the authority to bind an insurance carrier to a risk without prior approval, and must maintain a $10,000 broker bond filed with the Department of Insurance to operate legally. To transform a property and casualty broker agent license from a passive credential into an active operational status, specific documentation must be filed electronically with the California Department of Insurance. For an individual acting as an agent, an admitted insurance carrier must submit an action notice of appointment, which officially establishes the agent's authority to represent that specific company. If you operate instead as an insurance solicitor, which is a natural person employed to assist an insurance agent or broker in transacting insurance, your employer must file an action notice of solicitor. Furthermore, individual producers transacting business under an organization must ensure that proper business entity registration is completed and that their individual license contains a business entity endorsement linking them to that entity. Maintaining your license over the long term requires strict adherence to a continuous education cycle. For a casualty broker agent, the California Insurance Code mandates the satisfactory completion of 24 hours of approved continuing education during each 2-year license renewal period. Within these 24 hours, the state strictly requires at least 3 hours to be dedicated explicitly to ethics training, which also incorporates mandatory anti-fraud awareness content. It is important to note that if you complete excess ethics hours during a single renewal cycle, those extra hours will only roll over into the next cycle as general continuing education credits. They will not satisfy the mandatory 3-hour ethics requirement for the subsequent 2-year period, meaning you must take fresh ethics courses every single cycle. During periodic Department of Insurance market conduct audits, The burden of proving legal compliance rests entirely on the license producer and the business entity. Licensees are legally required to maintain thorough record-keeping systems that document their authority to act, including active appointments, solicitor agreements, and broker bonds. Failing to produce these documents upon request or allowing a gap between active appointments and transactions can trigger severe regulatory penalties, license suspension, or hefty administrative fines. You must treat these administrative tasks not as optional paperwork, but as the core architectural framework that keeps your insurance practice legally compliant and operational. See you in the next lecture. Welcome back. Today we examine the interface between the California Insurance Code and the market for risk that cannot find a home within standard parameters. Our focus shifts from admitted carriers to the regulatory landscape governing non-admitted insurers and the strict boundaries placed around surplus lines transactions. To understand this environment, we must first establish the structural difference between an admitted carrier and a non-admitted entity. An admitted insurer has obtained a formal certificate of authority from the California Department of Insurance, which grants it permission to transact business within the state. This status places the carrier directly under local regulatory oversight regarding forms, rates, and consumer protection funds. Conversely, a non-admitted insurer does not hold such a certificate. It is not licensed by California, which means its policies are not backed by the California Insurance Guarantee Association. When traditional admitted markets refuse a risk due to its unusual, hazardous, or high-capacity nature, the non-admitted market provides the necessary capacity to ensure the public remains protected against catastrophic financial loss. Because non-admitted carriers operate outside traditional state rate and form regulations, the California Insurance Code relies on financial solvency listings to protect consumers. The primary tool for this oversight is the list of approved surplus line insurers, commonly referred to as the LASLI. The California Department of Insurance maintains this voluntary registry to pre-approve non-admitted carriers that meet rigorous financial criteria. For a United States domiciled foreign insurer to qualify for placement under California home state rules, it must demonstrate substantial financial strength, including maintaining a minimum of $45 million in capital and surplus. Additionally, these companies must provide certified financial statements, national regulatory background checks, and proof of a minimum 3-year operating history to verify their ongoing stability. The burden of navigating this regulatory divide falls directly upon a licensed surplus lines broker. A standard property and casualty agent cannot simply place a policy with a non-admitted carrier when an admitted option proves inconvenient or expensive. Under Section 1763 of the California Insurance Code, a surplus lines broker is legally obligated to ensure that a diligent search is executed across the admitted market before exporting any risk. This search is not a superficial exercise. It requires making an active inquiry to insurers that actually write the specific type of coverage needed. The statutory benchmark for a valid diligent search requires documentation showing that at least 3 admitted insurers have formally declined the risk, or proof that fewer than 3 admitted carriers actually write that class of coverage in California. Brokers must formalize the results of this inquiry by executing a standardized document known as the SL2 Diligent Search Report. This form must be signed by a licensed individual who either conducted the search themselves or directly supervised the process. It is an explicit violation of the California Insurance Code to export a policy to a non-admitted carrier solely to secure a lower premium than what is available in the admitted market. Price competition cannot justify bypassing admitted carriers if those carriers are willing to accept the risk. The broker must file this report with the Surplus Line Association of California within 60 days of placing the coverage, establishing a clear paper trail that confirms the admitted market was genuinely exhausted. Beyond the diligent search requirement, the law mandates explicit transparent consumer disclosures to ensure the insured fully comprehends the legal reality of their policy. Section 1764.1 dictates that the applicant must sign a specific standardized disclosure statement, known as the D-1 form, at the time the insurance application is accepted. The statute requires this warning to be printed on a standalone document in boldface 16-point type to prevent the language from being obscured within standard contract templates. The disclosure informs the insured that the policy is issued by an unlicensed carrier, that the state does not regulate its rates or forms, and that the California Insurance Guarantee Association will not respond if the carrier insolvently collapses. The broker must retain this signed disclosure in their files for at least 5 years from the cancellation or expiration date of the policy. Furthermore, an identical warning statement, often referenced as the D2 disclosure, must be prominently displayed or affixed directly to the front page of every policy certificate or binder issued by a non-admitted entity. The strictness of this phrasing is non-negotiable under the California Insurance Code, and failure to secure the signed document exposes the broker to severe administrative penalties. There are narrow exemptions to the signed signature requirement, specifically when dealing with an industrial insured who meets high premium thresholds and employs full-time insurance managers. But for standard consumer placements, the disclosure is absolute. When a policy is bound under these conditions, the contract becomes legally binding on both parties, but the liability for compliance rests entirely on the shoulders of the transacting broker. See you in the next lecture. Welcome back. We are turning our attention to consumer protection and disclosures within the context of the California Insurance Code. When you transact business in the admitted market, the state provides a baseline of structural safety that the consumer often takes for granted. When you move a client into the non-admitted or surplus lines market, that floor disappears. Because the consumer assumes significant risk, the law shifts the burden of explicit transparency entirely onto the producer and the surplus lines broker. Your responsibility is to ensure the applicant understands exactly what they're sacrificing in exchange for coverage that the admitted market refuses to write. The primary tool for this transparency is the mandatory disclosure statement defined under California Insurance Code Section 1764.1. This is not a casual notification buried in the fine print of an application. The law requires a specific 16-point boldface font disclosure that must stand alone as a freestanding document. The visual formatting is a strict statutory mandate designed to prevent the consumer from skimming past it. The disclosure must explicitly state that the policy is being issued by an insurer not licensed by the state of California. It must clearly articulate that the insurer is not subject to the same financial solvency regulations and enforcement that govern admitted carriers. The most critical piece of information within this bold-faced document concerns the state guarantee funds. You must explicitly inform the consumer that the non-admitted insurer does not participate in any of the California Insurance Guarantee Funds. If a non-admitted carrier becomes insolvent and lacks the capital to pay outstanding claims, the state will not step in to protect the consumer's assets or fulfill those claims. This absence of a safety net is the defining operational characteristic of the surplus lines market, and the law demands that the client explicitly acknowledges this risk by signing and dating the form at the time the application is accepted. As a producer, your advisory duty extends beyond handing over a standard form. You have an obligation to explain the differences in premium and coverage terms when comparing a non-admitted quote to any available admitted options. Surplus lines policies often contain unique exclusions, higher deductibles, or restrictive conditions that do not exist in standard admitted forms. Furthermore, surplus line transactions often involve non-refundable fees and taxes added onto the base premium. Failing to detail these structural variances leaves the consumer exposed to unexpected financial liabilities and violates the fundamental standards of transparency established by the code. Compliance with these disclosure rules requires strict administrative discipline, particularly regarding record keeping. Once you secure the applicant's signature on the freestanding disclosure form, that document becomes a critical legal record. The surplus lines broker or the producing licensee who receives the originally signed form must maintain it within their files for a minimum period of 5 years. This retention period begins from the date the policy expires or is canceled. These records must remain readily accessible and available for inspection by the insurance commissioner or the insured upon request to prove that the mandatory disclosure occurred before coverage was bound. There are limited scenarios where the immediate signature requirement is altered, specifically when an applicant requires coverage to be bound immediately. If existing coverage lapses within 2 business days, or if the client needs immediate protection and the transaction occurs via phone or electronic transmission rather than face-to-face, the producer may transmit the form for a signature after binding. However, if the client does not receive the disclosure form and a request for a signature within the mandated time frame, they retain the right to cancel the policy on a pro rata basis, and any broker fees charged for the placement must be returned. This penalty emphasizes that the state protects the consumer's right to timely information. Ultimately, mastering these disclosure provisions ensures that you can clearly articulate the limitations of coverage and the inherent risks associated with non-admitted markets. Placing a policy with a non-admitted carrier is a valid and necessary solution for complex or high-risk exposures, but it must never be done blindly. By ensuring the 16-point boldface disclosure is signed, retained for 5 years, and fully understood, you protect both the consumer from financial surprise and your own professional standing from compliance violations. See you in the next lecture. Welcome back. The California Department of Insurance possesses a structured apparatus designed to monitor market conduct and enforce compliance with the California Insurance Code. This regulatory oversight is not an abstract exercise in bureaucracy, but a concrete framework that dictates how you must interact with the public, handle claims, and execute underwriting duties. When the commissioner initiates a market conduct examination, the focus is squarely on identifying systemic deviations from established state statutes. Understanding the boundaries of this enforcement mechanism is vital because the state does not view compliance as a soft guideline. Instead, the code provides the Department of Insurance with specific tools to investigate market activities, analyze consumer complaint ratios, and deploy field bureaus to audit company books directly. When a regulatory inquiry begins, you must understand that the producer is granted explicit rights during the investigation process, but these rights exist alongside stringent obligations. You have the right to administrative due process, which includes receiving formal notice of noncompliance or an order to show cause before severe penalties are finalized. You also maintain the right to a hearing before an administrative law judge to contest the Department of Insurance findings, provided you file the appropriate application within the statutorily mandated timelines. However, these rights do not shield you from the obligation to cooperate fully with investigators or to produce requested documentation in a timely manner. Attempting to obstruct an inquiry or failing to provide records during a market analysis will only aggravate the regulatory response and accelerate disciplinary action against your license. The financial and operational consequences of noncompliance are structured to deter bad behavior through significant civil and criminal sanctions. For instance, engaging in insurance transactions without a valid license or executing fraudulent acts exposes an individual to severe legal jeopardy. Under the California Insurance Code, unlicensed activity is treated with extreme severity, carrying civil penalties that can reach up to $10,000 per day for continuing violations, or up to $25,000 per violation if the conduct is proven to be willful. Furthermore, acting as an unauthorized producer or participating in insurance fraud can cross the line from a civil matter into criminal prosecution, resulting in misdemeanor or felony charges that carry mandatory jail time and heavy criminal fines. The state uses these aggressive financial and criminal levers to protect the integrity of the admitted market and ensure a level playing field. Beyond immediate fines and legal actions, regulatory findings have a devastating long-term impact on your professional license status and your future career in the industry. The commissioner has the statutory authority to suspend or permanently revoke a producer's license based on the gravity of the market conduct violations discovered during an audit. A revoked license often comes with a multi-year ban before you can even apply for reinstatement, and the code requires the department to publish these enforcement actions on its public database. This permanent public record creates a significant reputational barrier, effectively preventing you from securing company appointments or obtaining a non-resident license in other jurisdictions, which uniformly require disclosure of past regulatory disciplines. Managing regulatory risk proactively by establishing airtight compliance protocols is the only reliable method to avoid these catastrophic operational outcomes. See you in the next lecture. Hello, and welcome back. We are moving directly into the structural mechanics of how insurance policies are legally terminated midterm in the state of California. Midterm policy termination requires strict adherence to statutory timelines, or the action is legally void. Under California Insurance Code Section 662, which governs personal automobile policies, a standard cancellation requires at least a 20-day advance written notice to the insured. However, Section 677.2, which regulates commercial insurance lines, mandates a stricter 30-day notice period for general midterm cancellations. Both statutory frameworks establish a distinct 10-day notice requirement if the cancellation is driven strictly by the non-payment of premium. You must memorize these specific day counts because the state licensing examination frequently tests your ability to differentiate between personal and commercial standard timelines versus the universal baseline for financial default. If an insurer issues a notice that falls even a single day short of these minimum mandates, the cancellation fails entirely and the policy remains fully active. To calculate the effective date of a cancellation accurately, you must apply the legal guidelines found within the California Code of Civil Procedure alongside the insurance code. When a cancellation notice is sent via regular mail, Section 1013 adds specific extensions to the statutory notice windows based on where the mail originates and its destination. For a notice mailed from within California to an insured resident within the state, you must add 5 calendar days to the statutory minimum timeline. This means a 10-day non-payment notice sent by mail actually requires 15 days from the date of mailing before the coverage can legally terminate. If the notice is mailed to an address outside of California, but within the United States, the extension increases to 10 days, and it reaches 20 days for international mailings. Valid service of notice demands specific physical or electronic execution to withstand legal scrutiny. The insurer must deliver or mail the written notice directly to the named insured at the exact mailing address shown on the declarations page, while also providing copies to the producer of record and any listed lien holders. While personal automobile rules allow electronic delivery of notices to lien holders if they have explicitly consented, commercial guidelines under Section 677.2 require comprehensive delivery parameters. A critical component of a legally compliant notice is the mandatory inclusion of the precise effective date and the explicit, detailed reasons for the cancellation. An insurer cannot simply state that a policy is being terminated. They must document the factual basis, such as a substantial increase in the hazard insured against or material misrepresentation. An insurer must maintain robust documentation to provide indisputable proof of delivery for every notice issued. For personal lines under Section 662, standard proof of mailing via the United States Postal Service is generally sufficient to establish that the notice was sent. For commercial risks subject to Section 677.2, the state requires a higher threshold of verification, often demanding certified mail with a return receipt requested to guarantee a legal paper trail. These meticulous record-keeping measures exist because the burden of proof rests entirely on the insurance carrier if an insured claims they never received the warning. Lien holders and additional interests possess distinct rights to notice, and their financial coverage cannot be terminated unless they receive their own independent, timely notification. It is highly important to separate the statutory mechanics of policy cancellation from the legal rules governing policy non-renewal. Cancellations occur midterm and strip away existing coverage during the policy period, which is why the state heavily restricts the practice to narrow grounds like fraud or non-payment. Non-renewal occurs at the natural expiration of the policy term, where the insurer simply chooses not to extend coverage for a subsequent period. Because non-renewals do not disrupt an active policy term, they're subject to entirely different notice intervals, such as a 45-day or 60-day window, depending on the type of property involved. Do not confuse the 10, 20, or 30-day midterm cancellation timelines with these longer, separate end-of-term non-renewal requirements when analyzing exam questions. Goodbye for now, and I will see you in the next lecture. Welcome back. Let us examine the specific statutory exceptions that alter the standard procedural mechanics of policy cancellation within the state of California. The California Insurance Code, or CIC, establishes definitive operational baselines for canceling property and casualty policies, which typically require a standard advance notice time frame of 20 or 30 days, depending on the specific line of business. However, when an insured fails to pay their premium or when the insurer discovers proven fraud, the risk profile changes immediately, prompting the code to provide an expedited statutory mechanism. For both non-payment of premium and discovery of material misrepresentation or fraud, the CIC shortens the required advance notification period down to exactly 10 days. This 10-day time frame is uniform and absolute, allowing an insurer to terminate its exposure rapidly while still providing a brief statutory window for the consumer to receive notice. It is important to note that this expedited timeline is a privilege granted strictly under these narrow conditions, and attempting to apply a 10-day notice window to any standard underwriting cancellation constitutes a direct regulatory violation. When dealing with a cancellation based on non-payment of premium, the 10-day notice function acts as a conditional warning rather than an immediate absolute termination. Under the CIC, a cancellation for non-payment becomes effective on the date specified in the notice only if the insured fails to cure the financial delinquency by the end of that 10-day period. This means that if the missing premium payment is delivered to the insurer or the producer of record before the 10 days expire, the cancellation notice is legally nullified and coverage must continue uninterrupted. The insurer does not have the right to refuse a valid cure during this window, making timing an essential element of your record keeping. For commercial or personal property policies with coverage amounts of $100,000 or more, the code introduces an additional procedural layer by requiring that this notice of cancellation for non-payment be sent via certified mail to the named insured and any designated third parties. Canceling a policy due to fraud carries a significantly higher operational burden of proof for the insurer and the producer than a simple case of non-payment. The CIC permits an expedited 10-day cancellation if the insurer discovers fraud or material misrepresentation committed by the named insured, but this action cannot be based on mere suspicion or casual assumption. The insurer must possess documented, verifiable evidence establishing that the insured intentionally misled the company regarding a factor that directly impacts the underwriting risk or a submitted claim. Because an allegation of fraud seriously impacts an insured's reputation and ability to secure future coverage, California law provides the policyholder with a clear right to formally contest the cancellation through the Department of Insurance. If the insurer proceeds with an expedited fraud cancellation without an airtight evidentiary paper trail, the company exposes itself to severe legal pitfalls, including wrongful cancellation lawsuits and regulatory sanctions. To protect your agency and the insurer from administrative penalties, drafting accurate cancellation notifications must follow a precise legal protocol. Every notice must be in writing and must explicitly state the exact effective date of the cancellation along with the specific, detailed reason for the action. Under CIC regulations, a copy of this written notification must be delivered or mailed simultaneously to both the named insured and the producer of record, provided that the producer is an independent representative and not a direct employee of the insurer. If you fail to include the clear statutory reason, or if you fail to notify the producer of record within the proper time frame, the notice is legally defective and the cancellation is deemed void. Compliance with these strict communication protocols is the only way to avoid regulatory scrutiny and ensure that the termination of risk stands up under legal examination. See you in the next lecture. Hello, and welcome back. When a policy is canceled, the transaction does not end with the decision to terminate coverage. From a regulatory perspective, the execution of that decision requires a rigorous adherence to record-keeping mandates. Under the California Insurance Code, the burden of proving that a policy cancellation was valid rests heavily on the documentation maintained by the insurer and the producer. If a dispute arises, or if the Department of Insurance conducts a market conduct examination, the absence of clean, structured records is legally equivalent to having never sent the cancellation notice at all. This means you must treat every cancellation as a potential legal dispute that requires a verifiable trail of evidence. To establish that a notice was properly issued, California Insurance Code Section 664 states that proof of mailing to the named insured at the address shown in the policy constitutes sufficient proof of notice. However, simply dropping an envelope into a mailbox is insufficient. The insurer must maintain verifiable evidence of mailing, which typically involves a United States Postal Service certificate of mailing or a detailed electronic log from an automated mail tracking system that captures the date, time, and specific destination address. When an insured requests a cancellation or a policy modification, the producer must secure and store the signed written request or digital receipt from the insured. Maintaining these receipts and specific correspondence logs ensures that the chronological sequence of events can be reconstructed with absolute certainty during an audit. The exact timing of a notice determines its statutory validity, making the time-stamping of notices a critical requirement. A cancellation notice must be time-stamped at the point of creation and delivery to demonstrate strict compliance with state-mandated timelines, such as the 10-day requirement for non-payment or the 30-day requirement for other valid business reasons. Furthermore, the content of a notice itself must satisfy specific state-mandated disclosures. According to California Insurance Code Section 677.2, the notice must clearly articulate the effective date of the cancellation and the precise reasons for the termination. If the text fails to include these disclosures, or if the timestamp indicates the notice was sent even a day late, the entire cancellation becomes legally void and the coverage remains active. As a producer, you occupy a critical position between the insurer and the policyholder, and your role extends to validating that the insurance company has followed all statutory procedures. You cannot simply assume that the carrier has properly executed and documented cancellation. Reviewing the transaction history and validating that the mandatory records exist protects both your professional liability and the interests of your client. If a claim occurs after an improper cancellation, a lack of documentation can expose you to errors and omissions claims, while exposing the insured to uninsured losses. Ensuring that all record-keeping procedures are meticulously executed is a fundamental operational necessity for managing professional risk in California. See you in the next lecture. Welcome back. Today we are going to look at the financial mechanics of midterm policy cancellations, specifically focusing on how the California Insurance Code dictates the calculation of unearned premiums. When a policy terminates before its scheduled expiration date, the contract cannot simply vanish without a formal accounting of the remaining premium. The core metric driving this process is the unearned premium, which represents the portion of the total policy premium that corresponds to the remaining unexpired days of the policy term. Under California law, the specific entity that initiates the cancellation alters the legal standard and calculation methodology applied to this fund. If the insurance company triggers the cancellation, the California Insurance Code generally mandates that the refund must be calculated on a strictly pro rata basis. A pro rata calculation is entirely linear and mathematical, requiring the insurer to return a proportion of the premium that exactly matches the unexpired duration of the contract, meaning the insurer can only retain the exact dollar amount that account for the days they actually provided active coverage. To understand the financial implications of a pro rata calculation, it is helpful to look at a concrete technical breakdown of the math. Consider a commercial property policy written for a standard one-year term of 365 days with a total annual premium of $3,650. If the insurance company cancels this policy midterm after exactly 100 days of coverage have elapsed, the calculation requires dividing the remaining 265 unexpired days by the total term length. This ratio is then multiplied by the total premium, meaning the calculation consists of 265 divided by 365 multiplied by $3,650. The resulting unearned premium refund due to the policyholder is exactly $2,650. Under a pro rata requirement, the insurance carrier is strictly prohibited from assessing administrative fees, penalties, or transactional costs against this unearned premium balance, ensuring that the consumer receives an unpenalized, proportional refund of their money. The legal framework shifts significantly when the termination is a voluntary, insured-initiated cancellation. When a policyholder chooses to cancel their own coverage midterm, the California Insurance Code permits insurers to utilize a short rate calculation method rather than a standard pro rata split. A short rate calculation is designed to allow the insurance company to retain a greater portion of the premium than the simple calendar days on risk would dictate, effectively acting as a financial disincentive for early termination and covering the administrative expenses of setting up the account. Historically and practically in California, a typical short rate penalty is calculated by taking the standard pro rata unearned premium amount and deducting a structural fee, which frequently equates to roughly 10% of that unearned balance. Alternatively, insurers may apply a pre-filed, tiered short rate table where the penalty percentage is heavily front-loaded, meaning the financial penalty is significantly higher if the insured cancels the policy during the first month than if they cancel it near the end of the term. The financial reality of a short rate cancellation can be illustrated by applying it to that same $3,650 annual policy canceled by the insured on day 100. Under a pro rata calculation, the return premium would be $2,650, but a standard 10% short rate penalty changes this outcome completely. The insurer calculates 10% of the 265 days of unearned premium, which amounts to a $265 penalty that is subtracted directly from the refund. Consequently, the insured receives only $2,385 back, while the insurance carrier pockets a total of $1,265 for just 100 days of actual exposure. Because of this substantial financial impact on the consumer, Section 481 of the California Insurance Code strictly requires that any policy containing provisions for a short rate or non-pro rata refund must explicitly disclose this penalty structure in writing to the applicant, including the specific percentages or maximum fees that can be applied. Beyond the calculation of the premium itself, California regulations place strict legal responsibilities on the insurance broker regarding the handling and ultimate distribution of these return funds. When an insurer issues a premium refund following a policy cancellation, the The broker has a statutory duty to ensure that all unearned premiums and associated fees are managed and returned in full compliance with state accounting timelines. If a broker receives a premium refund or an unearned commission distribution from an insurer or a premium finance company, they must tender those funds to the insured within 25 days of receipt. Furthermore, while standard insurance commissions are tied to the earned premium, broker fees charged directly to the client are typically governed by separate, standalone broker fee agreements. California Department of Insurance rules state that these broker fees are often legally non-refundable even upon midterm cancellation, unless the broker acted with demonstrable incompetence or dishonesty, meaning the broker must meticulously account for every dollar to avoid severe regulatory penalties. See you in the next lecture. Hello, and welcome back. When an insurance policy is canceled, it is easy to focus entirely on the relationship between the insurer and the named insured. However, a property insurance policy rarely exists in a vacuum, as financial institutions often hold a significant financial stake in the insured property through mortgages, liens, or loss payee clauses. Under the California Insurance Code, these third parties possess distinct legal rights that protect their collateral from uninsured losses. A failure to recognize and honor these rights does not merely compromise the financial institution. It exposes the insurance producer to significant errors and omissions liability. Understanding the mechanics of how the law treats these entities during a policy termination is a primary requirement for anyone managing property lines in California. The California Insurance Code establishes a strict legal duty regarding how and when third-party interests must be notified of a policy cancellation. Sections 662 and 677 dictate that a notice of cancellation is completely ineffective against a mortgagee, lien holder, or additional interest unless a copy of that notice is delivered to them. Crucially, the statute specifies that this notice must be provided to these third parties at the same time it is sent to the named insured. This parallel timeline ensures that a bank or lending institution is never left in the dark while a policy counts down toward termination. If an insurer satisfies the notification requirement for the insured but fails to send the concurrent notice to the listed lien holder, the cancellation is legally deficient regarding that third party. The policy will effectively remain in force to protect the financial institution's interest, even if the insured's coverage has successfully terminated. The mechanism of delivery has evolved with technology, and the California Insurance Code accommodates this through specific allowances for electronic transmissions. According to the code, notices made to lien holders may be transmitted electronically, via facsimile, or through personal delivery, but this is subject to a strict prerequisite: the express consent of the lien holder. An insurer cannot simply opt to send electronic notices to a financial institution without establishing this prior agreement. Furthermore, when electronic notice consent is active, the law enforces specific requirements for verifying the receipt of cancellation information. Under Section 38.6, a licensee must be able to demonstrate valid proof of delivery, and the electronic record is only treated as actually received if it complies with the standard statutory deadlines. Simply sending an email into the void is insufficient. The system must maintain retrievable records of delivery to verify that the lien holder's rights were respected. For insurance producers, the practical application of these third-party rights represents a major compliance focal point. When a policy is bound, ensuring that the lien holder's contact information, loan numbers, and delivery preferences are recorded accurately is not an administrative chore. It is a critical safeguard. If a policy is canceled for non-payment or a substantial increase in hazard, and the lien holder claims they never received the concurrent notice, the resulting dispute can quickly become an errors and omissions nightmare for the agency. Financial institutions have dedicated legal teams to enforce their loss payee protections, and they will hold the insurer or the negligent producer accountable if a fire or physical loss occurs on an uninsured property. Complying with state-mandated timelines and verification procedures is the only dependable method to protect your clients, your carrier, and your own professional practice. See you in the next lecture. Welcome back. When an insurance carrier issues a notice of cancellation, consumers often assume the decision is final and absolute under the California Insurance Code. However, policyholders have clear administrative and legal channels to challenge a cancellation that they believe violates statutory requirements or contractual agreements. As a property and casualty professional, your understanding of these mechanisms is critical because clients will naturally turn to you when they receive an unexpected notice of termination. You must understand how to guide them through the process of filing a formal grievance, managing timelines, and ensuring they do not inadvertently break the law or suffer an uncovered loss while a dispute is being actively investigated. Your role here is not to act as a judge or a legal representative, but to serve as a compliant, knowledgeable facilitator who preserves the client's rights under the code. The primary administrative remedy available to an insured who wishes to contest a policy cancellation is to request a formal review or an administrative hearing directly with the California Department of Insurance. The California Insurance Code provides that if an insured alleges a cancellation was executed unlawfully, such as missing the mandatory statutory notice window or lacking a valid statutory reason, the individual can file a comprehensive complaint with the insurance commissioner. Upon receiving this dispute, the Department of Insurance evaluates the facts to determine whether a proper, actionable complaint truly exists. If the commissioner validates the complaint, the regulatory body formally notifies the insurer of the dispute. At that juncture, the insurance carrier is faced with two specific statutory options under the law. They must either immediately reinstate the policyholder to their original position or formally request an administrative hearing to prove that their cancellation complied fully with state regulations. Navigating the exact timelines for these appeals is an area where producers must exercise absolute precision, as missing a regulatory deadline will completely forfeit an insured's right to challenge the carrier's decision. While general complaint submissions should occur immediately upon receipt of a questionable notice, formal statutory appeals regarding specialized cancellations or specific administrative orders carry rigid constraints. For instance, once the Department of Insurance or an administrative bureau issues an initial decision regarding a policy grievance, the aggrieved party typically has exactly 30 days from the date of service to file a formal appeal with the Administrative Hearing Bureau. If the insurer completely fails to respond to an initial request for action within the regulatory timeframes, the window for an insurer to escalate the matter can extend up to 120 days from the original filing. You must always ensure your clients understand that these statutory timelines are strictly enforced by the state and cannot be extended due to administrative delays or oversight. One of the most vital concepts you must convey to clients during an active dispute is the strict requirement for maintaining continuous insurance coverage. Filing a complaint or requesting an administrative hearing with the California Department of Insurance does not grant an insured a free pass to stop paying their premium, nor does it automatically absolve them of their financial obligations. To keep the policy enforceable while the state reviews the case, the insured must continue to make all scheduled premium payments fully and on time. If an insured chooses to withhold payment because they are angry about a cancellation notice, the carrier can legally cancel the policy for non-payment. This separate cancellation for non-payment is entirely valid under the California Insurance Code and will completely bypass the ongoing administrative dispute, leaving the client immediately exposed without any coverage and with no legal recourse. From the perspective of the insurance company, the California Insurance Code imposes clear obligations regarding whether they must pause or delay an active cancellation during an official investigation. If the insurance commissioner reviews an insured's complaint and determines that the initial cancellation appears contrary to existing California state law, the commissioner will issue an explicit order directing the carrier to maintain coverage or reinstate the risk. Once this official order is handed down, the insurer is legally obligated to pause the cancellation process and continue providing coverage while the formal administrative hearing is pending. If the final hearing ultimately concludes that the carrier's cancellation was indeed unlawful, the insurer will be forced to reinstate the policy retroactively to the original date of the attempted cancellation. Under these circumstances, the carrier becomes fully liable for any covered property or liability losses that occur during the dispute window, and they must reimburse the insured for any covered out-of-pocket expenses within 30 days of receiving the completed claim. As a licensed producer in the state of California, your administrative role in facilitating a cancellation dispute requires a careful balance of proactive client support and strict regulatory compliance. You can assist your clients immensely by helping them compile their critical documentation, which includes tracking the exact dates of mailing, verifying the written reasons provided on the cancellation notice, and organizing prior payment receipts. However, you must never alter policy terms, promise an outcome, or advise a client to stop paying their premiums while a dispute is being reviewed by the Administrative Hearing Bureau. Your primary responsibility is to act as a clear conduit of information between the insured, the insurance company, and the California Department of Insurance, ensuring all parties remain compliant with the code throughout the entire process. See you in the next lecture. Welcome back. Today, we will examine the legislative framework and architectural reality of the California Fair Access to Insurance Requirements Plan, commonly known as the FAIR Plan. To understand the FAIR Plan, we must look directly at its statutory source code, which is found in California Insurance Code sections 10090 etc. The legislature established this program to stabilize the California property insurance market by guaranteeing that basic property insurance remains available to qualified applicants. Crucially, the statutory text emphasizes that the FAIR Plan is designed to be an insurer of last resort, meaning it steps in only when the private, voluntary market is entirely unavailable. It is not intended to compete with or replace private admitted insurers or surplus lines brokers. Instead, the framework acts as a temporary safety net, providing a mechanism to absorb risks that standard underwriting models reject due to high exposure, such as severe wildfire or brush hazards. By law, the system operates with the explicit goal of encouraging property owners to return to the voluntary market as soon as private capacity becomes accessible again. A common misconception among applicants and some practitioners is that the FAIR Plan is a state agency or a public entity funded by taxpayers. In reality, the operational framework contains absolutely no state, federal, or local public funding whatsoever. The entire apparatus is structured as an involuntary, syndicated fire insurance pool consisting of all private insurers licensed to write property and casualty business within the state of California. Under this pool arrangement, every single admitted insurer must participate in the FAIR Plan as a mandatory condition of maintaining its certificate of authority to transact insurance business in California. The FAIR Plan operates as a centralized placement facility that issues policies directly on behalf of these member companies, who collectively bear the financial underwriting responsibility. This structure ensures that no single private carrier is unfairly penalized by geographical anomalies or localized natural disasters, distributed evenly across the industry. The financial mechanism behind this syndicated pool relies on a strict, proportional distribution of operational results based on market share. Each member insurer participates in the writings, expenses, profits, and losses of the association based on its historical direct written premiums in the state. Specifically, an insurer's share is calculated in proportion to its total premiums written during the second preceding calendar year, compared to the aggregate premiums written by all participating companies. If the FAIR Plan experiences heavy losses that exceed its accumulated reserves and purchased reinsurance, the governing framework permits assessments to be levied against the member insurance companies to cover the shortfall. Conversely, if the pool generates an underwriting profit, those gains are distributed back to the member insurers using the exact same proportional formula. This ensures that the collective financial weight of the private market backstops the liabilities generated by properties placed within the residual pool. Governance of this placement facility is legally vested in a dedicated governing committee that oversees day-to-day operations under rules approved by the California Insurance Commissioner. Statutorily, this committee consists of 9 voting members who are elected annually by the participating insurance companies to represent the interests of the syndicated pool. To maintain regulatory oversight and balance, the Governor of California appoints 4 additional non-voting members to the committee. These non-voting positions are carefully allocated to ensure diverse perspectives, consisting of 1 representative for insurance agents, 1 for insurance brokers, 1 for surplus lines brokers, and 1 representative to advocate for the general public. While the day-to-day administration and underwriting guidelines are managed by this industry-led committee, the insurance commissioner retains absolute veto and regulatory authority. The commissioner must formally approve the plan of operation, rate adjustments, and any structural revisions to ensure compliance with the overarching legislative mandate. See you in the next lecture. Welcome back. To qualify for the California FAIR Plan, a property owner must satisfy specific criteria designed to reinforce its position as the state's insurer of last resort. The core requirement mandates that the applicant must have unsuccessfully attempted to obtain property insurance in the standard admitted market. This means the normal, competitive voluntary market must have declined the risk, which often happens in areas exposed to severe brush or wildfire hazards. This operational boundary ensures the FAIR Plan does not compete with private enterprises, but instead acts exclusively as a temporary safety net. The underlying principle relies on the property being fundamentally insurable, meaning it must not possess uncorrected hazardous conditions or extensive, unrepaired damage that violates basic safety codes. If a homeowner can secure coverage from a standard private insurer, they are legally ineligible for the FAIR Plan, regardless of premium pricing or geographic preferences. The application process relies heavily on licensed insurance producers who act as the primary conduit between the consumer and the association. A broker must submit the initial application along with comprehensive documentation via the online broker portal, which serves as the centralized hub for managing these risks. The producer must provide exhaustive property details, including accurate square footage, roof construction type, proximity to brush, and recent structural renovations, alongside mandatory photographic evidence of all 4 sides of the structure. Brokers have access to specialized tools, including the FAIR Plan's online broker finder and specific underwriting risk mapping systems, to evaluate properties and locate potential coverage alternatives. Once the application is received, a physical property inspection is typically scheduled to verify the underwriting data and assess the actual risk characteristics. This formal process demands precise input from the producer, as inaccurate documentation directly delays policy issuance or results in coverage rejection. Understanding the strict limitations of the coverage provided by the FAIR Plan is critical for any producer preparing for the licensing exam. The base policy offers only basic fire insurance, strictly covering direct physical loss caused by fire, lightning, smoke, and internal explosion, with a hard maximum dwelling cap of $3 million per location. It does not provide comprehensive protection, omitting essential coverages found in standard homeowners policies such as theft, water damage, medical payments, or personal liability. To address these critical exposures, an insured must work with their broker to purchase a separate, supplemental policy known as a difference in conditions policy from the voluntary market. The FAIR Plan does not establish the replacement cost of a dwelling, which places the burden entirely on the applicant and their broker to calculate building material and labor values accurately. Failing to properly evaluate these risk exposures leaves the property owner significantly underinsured in the event of a catastrophic loss. The ultimate objective of the Fair Plan framework is the eventual transition of insureds back into the competitive, admitted insurance market when conditions improve. California statute requires the Fair Plan to maintain a clearinghouse program, an initiative designed to reduce overall policy volume by matching existing policyholders with admitted insurers. This database allows admitted carriers to review policy data and proactively offer comprehensive coverage options to consumers through their established brokers of record. When local infrastructure upgrades, community wildfire mitigation efforts, or shifting market appetites reduce the area's perceived fire risk, private carriers often return to write business. The transition strategy relies on a structured sequence where non-admitted carriers can access clearinghouse data only after admitted carriers have exhausted their first right of refusal. Moving a consumer out of the pool and back into the traditional market restores comprehensive coverage under a single policy, fulfilling the legislative intent of the program. See you in the next lecture. Welcome back. Understanding the precise coverage scope and operational boundaries of the California Fair Plan is a prerequisite for advising clients who are excluded from the voluntary insurance market. We must treat the Fair Plan as a restrictive, named peril instrument rather than a substitute for standard comprehensive policies. The baseline framework of a Fair Plan dwelling contract covers only a handful of specific perils, namely fire, lightning, smoke, and internal explosion. If a client requires protection against windstorm, hail, riot, civil commotion, or damage from vehicles and aircraft, these must be explicitly appended to the contract as optional extended coverages, as they are not inherent to the core policy structure. Similarly, vandalism and malicious mischief are entirely excluded from the foundational form and require a separate endorsement to be activated. By default, the valuation method used to settle losses under these contracts is actual cash value, which factor in physical depreciation, though policyholders can choose to purchase endorsements for replacement cost valuation on both the dwelling and personal property. The most critical realization for a producer is that the Fair Plan, by its statutory design, lacks the comprehensive liability and property protections found in traditional HO3 policies. Fundamental exposures such as third-party personal liability, medical payments to others, theft of personal property, and any form of water damage, including sudden pipe bursts or sewer backups, are fundamentally excluded. To bridge these massive structural gaps, property owners must secure a separate wraparound policy known as a difference in conditions contract from the voluntary market. A difference in conditions policy is specifically engineered to exclude the fire-related perils covered by the state pool while absorbing the liability, theft, and water damage exposures that the pool refuses to touch. As licensed producers, you must explicitly warn clients that relying solely on a Fair Plan policy leaves exactly half of their traditional residential exposures completely unprotected against loss. We also need to analyze the strict statutory coverage caps that govern these policies, which represent hard limits regardless of the actual replacement cost of a high-end property. For residential risks, the total maximum limit of liability across all combined coverages, which includes the primary structure, other structures, personal property, and fair rental value, is strictly capped at $3 million. For commercial risks, the operational landscape has adapted to larger exposures through a tiered framework that caps standard commercial policies at $20 million per structure. High-value commercial exposures can potentially access limits up to $20 million per building with an aggregate location cap of $100 million under specialized commercial forms. If a residential client owns a structure with a reconstruction value exceeding the $3 million threshold, the Fair Plan will simply not cover the excess value, forcing the consumer to seek specialized excess fire insurance layers in the surplus lines market. Premium calculations within the Fair Plan are heavily influenced by the physical risk characteristics of the property, particularly its proximity to hazardous wildland areas. to incentivize risk reduction and stabilize escalating premiums. The framework integrates wildfire hardening discounts for properties that implement documented safety measures. These rating credits are applied when a property owner satisfies specific structural and defensible space criteria, such as installing ember-resistant vents, utilizing non-combustible roofing materials, clearing vegetation, and maintaining a continuous fuel modification zone around structure. When reviewing a client's risk profile, a producer should emphasize that executing these mitigation steps directly reduces the base rate factor applied by the pool. However, even with these adjustments, the contract remains bound by rigorous general exclusions common across all standard fire policies, meaning that no coverage will ever be extended for losses resulting from enforcement of local building ordinances, nuclear hazards, power failures originating off-site, or intentional acts of fraud and concealment by the insured. See you in the next lecture. Welcome back. Today we examine how the California Department of Insurance monitors the Fair Access to Insurance Requirements Plan, universally known as the FAIR Plan. While the California FAIR Plan operates day-to-day as a private association of insurance companies, it remains a creature of statutory mandate and is subject to strict regulatory oversight. The California Insurance Commissioner holds the explicit statutory authority to guide the evolution of this residual market mechanism, ensuring it aligns with changing public needs. Over the years, this authority has been exercised to expand commercial policy limits, mandate monthly installment payment options, and require premium discounts for wildfire risk mitigation. The administrative power of the Commissioner is not merely passive, as the Department of Insurance actively reviews the plan of operation to balance structural market stability with consumer availability. Under the California Insurance Code, the Commissioner possesses the leverage to compel the association to alter its internal guidelines when the public interest is underserved. This statutory bridge ensures that the state's safety net mechanism remains accountable to regulatory expectations, even during severe volatility in the voluntary admitted property market. To ensure transparency and operational compliance, the California Department of Insurance utilizes formal investigatory hearings and structured market conduct examinations. Investigatory hearings function as public, fact-finding proceedings where the Commissioner gathers testimony from consumers, brokers, and administrators to diagnose systemic operational deficiencies. These public hearings frequently serve as the catalyst for broader enforcement actions, exposing issues ranging from restrictive policy interpretation to processing delays. Complementing these hearings are targeted market conduct examinations, which are rigorous, forensic audits of the association's actual business practices and claims handling records. For instance, recent market conduct exams revealed hundreds of statutory violations concerning the unlawful denial of smoke damage claims based on arbitrary criteria. When a market conduct exam uncovers a pattern of unfair claims practices, the Department of Insurance issues formal orders to show cause, forces compliance adjustments, and levies financial penalties. These regulatory mechanisms prove that the FAIR Plan is never exempt from the standard consumer protection laws that govern traditional private insurance carriers. A fundamental pillar of this regulatory framework is the statutory obligation of member insurance companies to participate fully in the residual market pool. Under California law, every admitted insurer licensed to write basic property insurance in the state must maintain membership in the FAIR Plan Association as a condition of keeping its certificate of authority. This mandatory participation means that private insurers must share equitably in the financial responsibilities, expenses, and catastrophic losses incurred by the pool based entirely on their statewide market share. When catastrophic events deplete the pool's resources, the insurance commissioner possesses the authority to approve multi-billion-dollar financial assessments levied directly against these member insurers. While state statutes permit these private companies to recoup a portion of these emergency assessments via temporary supplemental surcharges on their own policyholders, the initial liability rests squarely on the industry. This structural requirement ensures that the financial stability of the state's insurer of last resort is collectively backstopped by the entire admitted property insurance market. Beyond financial participation, member insurers and licensed producers must adhere to explicit legal requirements regarding the fair and equitable treatment of fair plan applicants. The California Insurance Code strictly prohibits the plan, its employees, and participating insurers from engaging in any form of unfair discrimination during the application or underwriting phases. While consumers are required to conduct a diligent search of the voluntary admitted market before applying to the residual pool, the application process itself must remain free from artificial barriers. Regulatory oversight ensures that rates remain actuarially sound and are never applied in an arbitrary or punitive manner to properties situated in high-risk zones. Furthermore, any violation of the fair treatment standard, such as misrepresenting policy terms or stalling the verification of eligibility, constitutes an actionable offense under the state's Unfair Practices Act. By integrating the operations of the pool directly into the state's primary regulatory code, California ensures that vulnerable property owners receive the same level of legal protection as any standard consumer. See you in the next lecture. Welcome back. Today we examine the financial framework that enables the California Fair Plan to operate as the state residual market mechanism for property insurance. While the Fair Plan issues policies and manages claims much like a standard insurance carrier, it is fundamentally structured as an involuntary joint reinsurance association. This means it does not possess independent capital in the way a conventional private corporation does, nor is it funded by taxpayers or state revenue. Instead, its financial stability is entirely underpinned by the collective capitalization of every admitted property and casualty insurance company licensed to write business within the state of California. By statutory mandate, participation in this pool is a non-negotiable condition for maintaining a certificate of authority to operate in the California insurance market. The distribution of operating costs, administrative expenses, and underwriting losses within the Fair Plan relies strictly on the principle of market share proportionality. Each individual member insurance company participates in the financial outcomes of the pool in direct proportion to its net direct written premiums in the voluntary market. The California Insurance Code dictates that this proportion is calculated based on the aggregate premiums written during the second preceding calendar year. For instance, if an admitted carrier wrote exactly 10% of the total voluntary property insurance premiums statewide 2 years ago, that specific carrier is legally responsible for exactly 10% of the Fair Plan losses and expenses today. This mechanism ensures an equitable distribution of risk, preventing any single insurer from being disproportionately burdened by the collective exposures of the residual market. When catastrophic events, such as widespread climate-driven wildfires, exhaust the Fair Plan premium reserves and its purchased reinsurance layers, the association maintains its solvency through the assessment process. The Fair Plan cannot simply default on its obligations or go bankrupt. Instead, it levies a mandatory financial assessment on its member companies to recapitalize the pool and ensure ongoing claims can be paid. These assessments require explicit authorization from the California Insurance Commissioner before they can be executed. Once approved, member insurers receive official notice of their pro rata financial obligation and are statutorily obligated to remit their allocated funds to the association, typically within 30 days. Recent history has demonstrated the scale of this mechanism, as evidenced by the $1 billion assessment approved to stabilize the pool following severe wildfire losses. Understanding this backstop mechanism clarifies the intense motivation driving both private insurers and state regulators to actively transition policyholders out of the Fair Plan and back into the voluntary market. For private insurance companies, every policy written by the Fair Plan represents an uncontrollable, shared liability that threatens their corporate balance sheets through potential future assessments. Even though modern regulatory frameworks allow carriers to recoup certain assessment costs from their own voluntary policyholders via approved temporary surcharges, the process introduces significant operational friction and financial strain. Consequently, both the industry and the Department of Insurance view the FAIR Plan strictly as a temporary safety net rather than a permanent competitive option. Depopulating the residual market remains a primary strategic objective to restore a healthy, self-sustaining voluntary insurance ecosystem in California. See you in the next lecture. Welcome back. We need to evaluate how the California FAIR Plan is adapting to the fundamental shifts in our environment and regulatory landscape. The modern reality of climate change has fundamentally altered the risk profile of property insurance across California. What was once considered a seasonal hazard has evolved into a year-round threat, driven by escalating wildfire frequency and severity. This environmental shift has placed unprecedented strain on the FAIR Plan, which was originally established to handle urban riots and localized brush fires, rather than systemic, climate-driven catastrophes. As private insurers began restricting coverage or withdrawing entirely from high-risk zones, the FAIR Plan experienced a dramatic surge in policies. This influx transformed it from a true mechanism of last resort into one of the largest property insurers in the state, holding hundreds of billions of dollars in total exposure. To maintain solvency and function within the broader California insurance economy, the state has had to introduce comprehensive regulatory overhauls. Understanding this evolution is critical because the code and regulations you are studying are not static. They're actively adjusting to prevent a total collapse of the state's property market. A central pillar of this regulatory adjustment is the Sustainable Insurance Strategy, implemented by the California Department of Insurance to restore market equilibrium. This strategy introduces major structural reforms to how insurance rates are determined and how admitted insurers must operate in high-risk areas. Historically, Prop 103 restricted insurers from using forward-looking catastrophe models for wildfire pricing, forcing them to rely strictly on historical data. The Sustainable Insurance Strategy modernizes this by permitting the use of advanced, predictive wildfire risk models and state-specific reinsurance costs in rate filings. In exchange for utilizing these precise tools to set more actuarially sound rates, private insurance companies are required to fulfill specific market commitments. Most notably, insurers must increase their footprint in historically underserved, wildfire-distressed areas, committing to write policies covering a minimum of 85% of their statewide market share in these zones. By allowing risk-based pricing while mandating localized market participation, the strategy aims to entice private capital back into communities that were previously abandoned to the residual market. Simultaneously, recent legislative updates and executive actions have targeted the capacity of the FAIR Plan itself, particularly regarding commercial properties. Many businesses, homeowners associations, affordable housing developments, and agricultural entities found themselves unable to secure adequate coverage because their total valuation far exceeded the old FAIR Plan limits. To address this coverage gap, regulatory orders expanded the commercial property limits under the FAIR Plan significantly. The current framework allows for commercial coverage limits of $20 million per building, with a maximum aggregate limit of up to $100 million per location. This massive expansion ensures that large-scale commercial structures and multifamily residential complexes in high-hazard zones can still access basic property protection. However, this increased capacity also amplifies the overall liability and potential exposure of the FAIR Plan pool. Consequently, new financial safeguards have been introduced to manage how catastrophic losses are distributed, capping the immediate liability of member companies and outlining specific mechanisms for recovering massive claims through approved policyholder surcharges if an extraordinary event occurs. The overarching, long-term objective of these combined regulatory and market reforms is a process known as attrition or depopulation. Attrition means systematically reducing the total number of policies held by the FAIR Plan by fostering a stable, competitive, and predictable private insurance market. The state does not want the FAIR Plan to function as a permanent, primary competitor to private enterprise, as its concentrated risk portfolio poses a severe systemic threat to the state's financial stability. True attrition occurs when private insurers, armed with better risk assessment models and clear regulatory guidelines, voluntarily take back properties from the residual market. As an insurance professional, you bear a significant responsibility to monitor these shifting policy debates and regulatory updates continuously. The rules governing cancellation timelines, non-admitted markets, and fair plan interactions are tied directly to these ongoing structural changes. Staying informed about these shifting dynamics ensures you can navigate the market accurately and advise clients effectively as California continues to rebalance its insurance economy. See you in the next lecture. Welcome back. Let's look closely at what it means to operate under the elevated regulatory standard of a surplus lines broker in California. When you step out of the admitted market, the safety net of the California Insurance Guarantee Association disappears, which is why the California Insurance Code imposes strict, non-negotiable legal obligations on you. Your primary responsibility is to act as a rigorous gatekeeper, protecting the consumer while ensuring the state receives its proper revenue. If you fail to meet these high standards of compliance and reporting, you risk facing severe administrative penalties, including the immediate suspension or permanent revocation of your professional surplus lines license. The absolute cornerstone of your duties under Section 1763 of the Code is ensuring that a diligent search is conducted within the admitted market before any risk is moved to a non-admitted carrier. This is not a casual check or a superficial inquiry. It requires a genuine, thorough attempt to place the coverage with admitted insurers that are actively writing that specific class of business in California. You cannot simply bypass the standard market because a non-admitted carrier offers a cheaper rate or more flexible terms. In fact, the code explicitly states that you are prohibited from placing insurance with a surplus lines insurer for the sole purpose of securing a rate lower than what an admitted carrier would accept. The admitted market must always have the first right of refusal for the risk. To prove that you actually performed this mandatory market search, you must meticulously document every single interaction and refusal. This documentation is standardized on California Department of Insurance Form SL-2, widely known as the Diligent Search Report. The individual who signs this form must hold a valid California property and casualty license and must have either performed the search themselves or directly supervised the person who did. You are required to file this report alongside the confidential report of placement on Form SL-1 with the Surplus Line Association of California within 60 days of placing the coverage. Furthermore, under Regulation 2190, you must retain the original signed documents in your records for at least 5 years, making them readily available to the insurance commissioner upon request. Beyond the initial placement and market documentation, you bear the sole responsibility for the accurate collection and timely filing of surplus lines premium taxes. Every surplus lines broker must make an annual state tax filing on Form FS-006 by March 1st, reflecting a statutory tax rate of 3% on all net taxable premiums transacted during the previous calendar year. Net taxable premium is calculated by taking the gross premium plus any associated policy or inspection fees, and then subtracting any return premiums. If your annual tax liability reaches $20,000 or more, you are legally required to participate in the Electronic Funds Transfer Program and make monthly tax installment payments using Form FS-007. Failing to file these returns or remit payments on time results in automatic penalties and interest charges that accumulate rapidly. Finally, your relationship with non-admitted carriers is governed by strict compliance boundaries that dictate which insurers you can legally utilize. You are responsible for ensuring that any non-admitted carrier you select is financially stable and meets the state's eligibility standards. For foreign insurers operating outside the United States, you must verify that they are actively maintained on the California list of approved surplus line insurers, which is managed by the Department of Insurance. Dealing with an unauthorized or unapproved non-admitted carrier without meeting specific legal exceptions is a straight path to regulatory action. Your role demands constant vigilance, impeccable record keeping, and an absolute commitment to state tax laws to maintain your compliance standing. See you in the next lecture. Welcome back. Today we're going to examine the operational realities of placing business in the non-admitted market under the California Insurance Code, specifically looking at the rigorous threshold of the diligent search. The surplus lines market exists to capture risks that standard carriers cannot or will not accept, but it is never meant to act as a primary choice for a broker. Under California Insurance Code Section 1763, an insurance producer cannot simply route a risk to a non-admitted insurer for convenience, faster processing, or a broader policy form. The statutory default is that the admitted market must always be given the first right of refusal for any given risk. To protect this market and ensure consumer protections remain intact, the code establishes strict parameters around what constitutes a diligent search of admitted insurers. A producer must thoroughly investigate the standard market before concluding that a risk must be exported to a surplus lines broker. To satisfy the statutory definition of a diligent search, a license holder must actively seek coverage from admitted insurers that are actually writing the specific class of insurance in California. This means you cannot satisfy the requirement by submitting a commercial property risk to companies that only write private passenger automobile coverage. The code establishes a clear benchmark for what creates prima facie evidence, meaning evidence sufficient to establish a fact unless disproved that a diligent search occurred. This benchmark is reached when a producer documents clear declinations from at least 3 admitted insurers that actively write that particular type of coverage. If fewer than 3 admitted insurers actually write the risk in California, the producer must explicitly document how they determined that a broader market does not exist. It is critical to understand that a diligent search cannot be used as a tool to find a cheaper price for the consumer. Section 1763 explicitly forbids placing a risk with a non-admitted carrier solely to secure a lower premium or a lower rate than what the lowest admitted insurer would accept. If an admitted carrier is willing to write the policy for $10,000 and a surplus lines carrier offers the exact same coverage for $8,000, the risk cannot be exported. The admitted carrier must be utilized because availability, not pricing superiority, is the sole justification for entering the surplus lines arena. The only exception to this rule applies to specific coverages placed on the state's official export list, where the insurance commissioner has already determined that an adequate admitted market does not exist. The operational responsibility for this process falls heavily on the licensed producer and the surplus lines broker who handles the placement. When a standard agent or broker cannot find coverage, they often work with a wholesale surplus lines broker to access non-admitted carriers. However, the surplus lines broker remains ultimately responsible for ensuring that a valid diligent search was performed and documented before the coverage is bound. This relationship requires clear communication and absolute honesty between the retail producer who interacts with the client and the surplus lines licensee who interacts with the non-admitted market. Negligence or shortcuts taken during the search process expose both parties to significant regulatory scrutiny and potential disciplinary action by the California Department of Insurance. Documentation is the absolute defense against accusations of improper placement, and California enforces this through a standardized reporting mechanism. The individual who performs or directly supervises the search must complete and sign California Department of Insurance Form SL-2, which is the official diligent search report. This document requires the full legal names of the 3 admitted insurers contacted, their specific National Association of Insurance Commissioners identification numbers, the date of the submission, and the exact contact information of the representative who declined the risk. Group names or marketing titles are unacceptable on this form because the state requires proof that a specific corporate entity turned down the business. This form must be filed with the Surplus Line Association of California within 60 days of placing the coverage. Maintaining these records is a strict statutory mandate designed to ensure accountability long after the policy has been issued to the client. Under California regulatory rules, the original signed Form SL-2 must be maintained by the licensee who signed the document for a period of at least 5 years after the expiration or cancellation date of the policy. Copies of this signed form must also be distributed to all other agents or brokers involved in the transaction, who must keep them in their respective client files. This paper trail protects the broker from regulatory penalties by creating an unassailable record showing that all code-mandated steps were executed correctly. Failing to maintain these records can result in heavy fines, license suspension, or the presumption that the business was illegally exported. See you in the next lecture. Hello. Welcome back. Navigating the regulatory waters of the non-admitted insurance market requires a firm understanding of the financial mechanics dictated by the California Insurance Code. When you place a policy through a surplus lines insurer, you operate outside the standard admitted structure, which means the traditional tax collection mechanisms do not apply. Instead, the state shifts the entire burden of tax compliance, collection, and remittance directly onto the shoulders of the licensed surplus lines broker. This responsibility is not merely administrative. It is a strict fiduciary duty to the state of California. The California Department of Insurance requires absolute precision when tracking these financial flows, as the state relies heavily on brokers to capture revenue that would otherwise escape the admitted market system. Failing to understand these obligations can quickly jeopardize your license and subject your operations to severe administrative penalties. The cornerstone of surplus lines financial regulation in California is the gross premium tax, which is currently set at a flat rate of 3% of the taxable premium transacted. This tax applies to all surplus lines policies where California is considered the home state of the insured, regardless of whether the risk itself is entirely located within state borders. As a broker, you must calculate this 3% tax based on the total gross premium charged to the insured, excluding any separate stamping fees or state filing fees, but including any policy fees charged by the insurer. It is important to note that this tax is a liability owed by the insured but collected and remitted by the broker. You must maintain these collected funds in a designated broker transmittal account, treating them as state funds held in trust rather than business revenue. To facilitate the reporting of these transactions, California utilizes the Surplus Line Information Portal, commonly referred to as the SLIP system, managed by the Surplus Line Association of California. Every time you place, renew, or extend a non-admitted policy, you must submit a detailed electronic filing through SLIP within 60 days of placing the coverage. This filing must include essential documents such as the Policy Declarations page, the Confidential Report of Placement, known as the SL-1 form, and when applicable, the SL-2 Diligent Search Report. The Surplus Line Association acts as the official stamping office for the state, auditing these SLIP submissions to verify that the premium data matches your eventual tax returns. In addition to the state tax, transactions processed through this system are subject to a separate stamping fee, which currently sits at 0.18% of the premium. The actual remittance of the accumulated 3% premium tax follows a strict statutory calendar that you must commit to memory for the exam. On or before March 1st of each calendar year, every surplus lines broker must file an annual statement and tax return with the insurance commissioner through the online premium tax processing system. This annual filing reconciles all transactional data submitted via slip during the previous calendar year, from January 1st to December 31st. If your total annual tax liability for the preceding year reached or exceeded $20,000, you're statutorily required to move from an annual payment schedule to a monthly installment schedule for the current year. These monthly installments are due on or before the first day of the second month following the month in which the business was transacted, and they must be paid via electronic funds transfer to avoid automatic compliance alerts. Disregarding these deadlines or mismanaging the submission timeline triggers immediate financial consequences and regulatory scrutiny from the California Department of Insurance. If a broker fails to submit the annual tax return or remit the required funds by the March 1st deadline, the state imposes an automatic penalty of 10% of the total tax amount due, plus an additional interest charge compounded monthly until the balance is paid in full. Furthermore, persistent late filings or systemic reporting errors are viewed by the commissioner as a breach of fiduciary duty, which can lead to the suspension or absolute revocation of your surplus lines license. The state views timely tax collection as a matter of market integrity, meaning that administrative oversight is rigid and excuses regarding technical difficulties or staffing shortages are routinely rejected. To ensure that all reported figures can be verified during a market conduct examination, the California Insurance Code mandates strict record-keeping standards for all non-admitted transactions. Brokers must maintain complete, orderly records of every surplus lines placement for a minimum period of 5 years following the termination or expiration of the policy. These records must be kept at your principal place of business in California and must include the original signed SL1 and SL2 forms, copies of the issued policies, clear accounts of all premiums collected, and detailed bank statements of your trust accounts. The California Department of Insurance reserves the right to inspect these documents at any time without prior notice to verify that the 3% gross tax was calculated correctly and that all funds were routed to the state treasury. See you in the next lecture. Welcome back. Today we're going to examine the precise legal mechanics of consumer disclosure obligations, specifically looking at how California regulates the communication between surplus lines brokers and applicants regarding non-admitted insurers. California Insurance Code Section 1764.1 establishes a rigid framework for notifying consumers that they are purchasing coverage from an insurer not licensed by the state. As a surplus lines broker, you cannot assume that an applicant understands the regulatory differences between the admitted and non-admitted markets. The law requires a proactive approach to ensure informed consent, which translates into specific documentation standards that you must execute perfectly to avoid severe regulatory penalties. This obligation is not a mere bureaucratic formality. It is a fundamental consumer protection mechanism designed to ensure that the insured understands they are forfeiting the protection of the California Insurance Guarantee Association. Failure to comply with these disclosure mandates constitutes a major regulatory violation that can result in the suspension or revocation of your license, alongside substantial administrative fines. The statutory disclosure requirements split into two distinct operational documents, commonly referred to in the industry as the D1 and D2 forms. The D1 form is a freestanding disclosure statement that must be provided to and signed by the applicant at the time the broker or producer accept an application for a non-admitted policy. You must use the exact wording prescribed by the statute, which informs the applicant that the company is non-admitted, is not subject to the same financial solvency regulations as admitted carriers, and does not participate in state guarantee funds. This signed document acts as prima facie evidence of the applicant's informed consent. You are required by law to maintain the original signed document, or a verifiable electronic image of it, in your records for at least 5 years following the termination or expiration of the policy. The D2 disclosure form contains substantially the same statutory text, but serves a different delivery mechanism, as it must be explicitly affixed to the front page of every policy document or certificate of insurance issued by a non-admitted insurer. The legal importance of how these disclosures look cannot be overstated, as Section 1764.1 mandates that both forms be reproduced in a highly specific visual format. Specifically, the text must be printed in boldface 16-point type. The California Department of Insurance treats font size and formatting as a strict liability issue, meaning that any text smaller than 16-point boldface renders the disclosure legally invalid, regardless of whether the client actually read it. This layout rule ensures that the critical warning is visually prominent and cannot be obscured within the fine print of a lengthy policy document. From a risk management perspective, managing this communication effectively serves as your primary professional liability protection against future errors and omissions claims. When a client suffers a massive catastrophic loss and discovers that their non-admitted carrier has become insolvent, the first thing their legal counsel will inspect is the validity of the D1 and D2 disclosures. If you fail to obtain a valid signature on a freestanding document at the time of application, or if you allowed the text to be printed in standard 12-point font, your professional liability exposure multiplies exponentially. Best practices dictate integrating these forms directly into your digital or physical workflow, ensuring that coverage is never bound or finalized until the signed D1 form is safely secured in your document management system. It is also critical to understand the narrow exceptions where a signed disclosure form is not legally required under California law. You do not need to secure a new signed D1 form when you're simply renewing a policy with the exact same non-admitted carrier, though the D2 notice must still appear on the front page of the renewed policy itself. Additionally, the signed form requirement is waived if the applicant qualifies as an industrial insured, which refers to large commercial entities that employ a full-time risk manager or retain a qualified insurance consultant to evaluate their exposures. Do not confuse an industrial insured with an exempt commercial purchaser, as the latter category does not automatically exempt you from the signed D1 requirement under the California Insurance Code. See you in the next lecture. Hello, and welcome back. When analyzing the California insurance landscape, we must distinguish between two fundamentally different types of entities operating within the state market. On one hand, we have admitted insurers, which are companies that have formally applied for and received a certificate of authority from the California Department of Insurance, or CDI, to transact specific classes of business. On the other hand, we have non-admitted insurers, which lack this specific state license and are often referred to as surplus lines carriers. This distinction is not merely academic, nor is it a measure of an organization's internal quality or ethical standards. Rather, it represents a profound difference in legal status, operational boundaries, regulatory oversight, and consumer protection mechanisms. As a professional, understanding this dichotomy is essential because the regulatory framework applicable to a given placement dictates the exact level of risk your client will absorb. Admitted insurers operate under the direct and comprehensive supervision of the CDI, which exerts strict control over their financial solvency, rate structures, and policy forms. This means that an admitted carrier cannot alter its premiums or change its policy language without prior approval from the state regulator, a process designed to ensure that rates are neither excessive, inadequate, nor unfairly discriminatory. Furthermore, these companies are subject to regular, intensive financial examinations by the CDI to verify that they maintain adequate reserves to meet all future obligations to policyholders. This heavy regulatory burden is the price of admission for doing business directly in the standard California market. For the consumer, this structure provides a high degree of predictability and state enforceability, ensuring that the contract they purchase conforms precisely to California law. Non-admitted insurers occupy a completely different regulatory space, as they are not licensed by the CDI and do not submit their rates or forms for prior state approval. This lack of direct oversight grants them immense operational flexibility, allowing them to underwrite unique, high-capacity, or highly unusual risks that the standard admitted market refuses to touch. However, the phrase non-admitted does not imply that these entities operate in a lawless vacuum without any oversight whatsoever. They are heavily regulated by their respective home states or countries of domicile, and their transactions within California are strictly monitored through licensed surplus lines brokers. To protect California citizens, the CDI maintains the list of approved surplus line insurers, commonly known as the Lastly list. This is a voluntary registry where non-admitted insurers can prove their financial stability by demonstrating strict adherence to capitalization, investment, and solvency standards established under California Insurance Code Section 1765.2, including maintaining a continuous minimum of $45 million in capital and surplus. The most critical practical difference between these two markets lies in the presence or absence of state-backed financial insolvency protection. Admitted carriers are legally required to participate in and financially contribute to the California Insurance Guarantee Association, which is universally abbreviated as CIGA. In the event that an admitted insurance company suffers financial collapse and enters liquidation, CIGA steps in as a statutory safety net to pay outstanding covered claims, generally up to a limit of $500,000 per claim. Non-admitted insurers, by contrast, do not participate in CIGA under any circumstances. If a non-admitted carrier becomes insolvent, its policyholders have absolutely no recourse to any state guarantee fund, meaning that claims may go completely unpaid and personal assets will remain entirely unprotected. This stark reality introduces a heightened risk profile to the non-admitted market, which must be clearly communicated to any prospective insured. Because of the inherent risks associated with the lack of guarantee fund protection, California law imposes a strict professional and ethical obligation on producers regarding market placement. You have a legal duty to attempt to place coverage within the admitted market first, utilizing the non-admitted market only as a secondary alternative when the standard market is genuinely unavailable. This requirement manifests as the diligent search mandate, which dictates that a surplus lines broker must thoroughly investigate the admitted market and receive rejections from actual admitted writers before moving a risk out of state. It is an explicit violation of the California Insurance Code to place a policy with a non-admitted carrier simply to secure a lower premium than what an admitted carrier would charge. Your primary professional directive must always be to recommend and pursue admitted coverage whenever it is available and reasonable, thereby maximizing the regulatory protections afforded to the consumer. See you in the next lecture. Welcome back. In this lecture, we turn our attention toward the ethical landscape that governs the surplus lines market, a space where your professional discretion as a broker carries significantly more weight than it does in the standard admitted market. Because the normal regulatory guardrails of the California Department of Insurance are less rigid here, the burden of consumer protection shifts squarely onto your shoulders. The primary ethical tension you will encounter in surplus lines brokerage stems from the friction between your compensation structure and your fiduciary duty to the client. Surplus lines placements frequently command higher premiums and unique fee structures, which can naturally result in larger commissions for the broker. This financial reality creates a potential conflict of interest where a less disciplined producer might feel tempted to steer a client toward a complex non-admitted policy simply to maximize revenue, even when an admitted solution might still be viable or modified to fit. To remain ethical, you must consistently decouple your financial incentive from your risk placement analysis, ensuring that the client's actual risk exposure and financial well-being dictate the solution. True professionalism in this niche requires that you treat commission as a byproduct of a correct placement rather than the driving force behind it. If you allow the premium size or the commission rate to skew your advice, you violate the core trust upon which a broker's license is issued. Transparency is your most effective tool for mitigating these inherent conflicts of interest, and it must extend far beyond simply handing over a mandatory disclosure form. Ethical brokers ensure that the client fully understands what it means to step outside the protection of the California Insurance Guarantee Association. You have a moral and professional duty to explain clearly that if the non-admitted carrier becomes insolvent, the state will not step in to pay their claims. This requires a deliberate conversation about the financial rating and stability of the surplus lines insurer you are proposing. Doing this properly means you do not bury the non-admitted status in fine print or treat the statutory disclosures as mere paperwork to be signed blindly. Instead, you proactively educate the insured so they can make an informed, calculated decision about assuming that extra layer of risk. Market volatility introduces another layer of ethical pressure, as sudden shifts in capacity can cause standard carriers to pull back from certain lines of business. When admitted markets harden rapidly, brokers often find themselves facing a flood of desperate clients and a severe shortage of time. In these high-pressure scenarios, the temptation to bypass a truly diligent search or to cut corners on proper documentation becomes acute. Ethical discipline means resisting the urge to rush a placement just because the client is facing a hard deadline or because a non-admitted carrier is offering a quick, expensive fix. You must remain methodical, ensuring that every required step of the diligent search is authentically completed and that you are not using market chaos as an excuse to relax your standards. Rushing a client into an inappropriate surplus lines policy to save time ultimately exposes both the insured and your brokerage to severe professional liability. Ultimately, professional ethics in surplus lines is about synthesizing the strict technical requirements of the California Insurance Code with an internal code of moral responsibility. The state grants surplus lines brokers a high degree of freedom to negotiate and place unconventional risks, but that freedom is explicitly conditioned on the expectation of superior market conduct. You are acting as an expert gatekeeper in a specialized financial market, and your technical competence must be matched by an unyielding commitment to fair dealing. When you master both the legal mechanics and the ethical boundaries discussed today, you protect the integrity of the entire surplus lines marketplace. Until next time, keep analyzing these concepts closely. Welcome back. We have reached the final stage of our journey through the California Insurance Code, and now it is time to synthesize these components into a cohesive mental model. To understand the California regulatory landscape, you must view it as an interconnected system of checks and balances designed to maintain market stability while protecting the consumer. The insurance commissioner sits at the center of this framework, wielding statutory authority derived directly from the code to enforce compliance and penalize market conduct violations. As a producer, your daily operations are strictly bounded by these regulations, meaning that every piece of advice you give, every application you submit, and every file you maintain is subject to this oversight. Passing the state exam requires you to see past isolated rules and recognize how administrative authority governs every transaction from standard admitted placements to specialized surplus lines wraparounds. State-specific knowledge is not merely a hurdle for licensing. It is the operational logic that keeps your future practice compliant and legally viable. Policy cancellation rules represent one of the most heavily regulated touchpoints between an insurer and an insured, requiring absolute precision regarding timelines and documentation. Under the code, standard midterm cancellations demand strict advance written notice, typically 20 or 30 days, depending on the specific line, but the exceptions for non-payment of premium and fraud drop that requirement to a strict 10 days. You must remember that these notice periods are absolute legal minimums, and any failure to document the proper mailing or delivery to both the insured and the producer of record invalidates the cancellation entirely. Furthermore, when a policy terminates mid-term, the financial resolution depends heavily on who initiated the action, utilizing pro-rata calculations when the insurer cancels and short-rate penalties when the insured requests it. These financial mechanics, along with the vested rights of lien holders and mortgagees who must receive independent notice of termination, ensure that risk management remains predictable and contractually sound for all parties involved. When a standard admitted market contracts and refuses to accept a risk, the California Fair Plan serves as the state's mandatory property insurance repository, operating as a joint reinsurance association of all admitted property insurers. The Fair Plan is not a private company, but a structural safety net designed to provide basic property coverage to individuals who are diligently searching for insurance, but cannot obtain it through standard channels. You must keep in mind that its coverage scope is explicitly limited to basic perils like fire and lightning, meaning consumers often need specialized wraparound policies from the private market to achieve comprehensive liability and theft protection. Because every admitted property insurer must participate in the Fair Plan and bear assessments based on their market share, the Commissioner maintains rigorous oversight over its operational framework to ensure market fairness. Understanding the eligibility criteria, the application process, and how the plan interacts with the broader admitted market is essential for solving complex situational questions on the exam. Surplus lines brokerages represent the final tier of placement complexity, managing risks that are too severe, unusual, or high capacity for the admitted market. A licensed surplus lines broker operates under a stringent set of statutory duties, chief among which is the requirement to conduct a diligent search of the admitted market before exporting any risk. This search requires checking with at least 3 admitted insurers who actually write that class of business, and the details must be meticulously documented on the standardized SL2 form within 60 days of placement. Brokers also shoulder heavy taxation and filing responsibilities, ensuring the state's surplus lines tax is collected and that consumers receive mandatory disclosures warning them that the policy is not backed by the California Insurance Guarantee Association. Navigating this boundary between admitted and non-admitted markets requires a deep commitment to professional ethics, as misrepresenting a risk or bypassing the diligent search to chase a lower rate constitutes a severe violation of the code. As you prepare to sit for the property and casualty exam, success will depend as much on your test-taking strategy as it does on your mastery of the legal facts. Read every question completely, paying close attention to qualifiers like except, minimum, or specific day counts, which are frequently used to differentiate similar regulatory scenarios. Do not rush to choose an answer that looks familiar without validating that it directly addresses the exact statutory condition described in the prompt. When faced with complex scenario questions involving cancellations, fair plan eligibility, or surplus lines compliance, systematically eliminate the answers that violate basic timelines or administrative hierarchies first. By organizing your study around the foundational relationships between consumer protection, insurer obligations, and producer compliance, you will easily decode the structure of the exam and carry these compliant habits into a successful professional career. See you in the next lecture.